How to hedge options with futures. Are you curious about how to protect your options investments using futures contracts? Let's break it down in a way that makes sense. Hedging is a strategy used to reduce potential losses by offsetting risks. When you hedge options with futures, you are using futures contracts to manage the risks tied to your options positions. First, let's clarify what futures and options are. Futures contracts are agreements to buy or sell an asset at a set price on a specific date. They help you guard against price changes in the underlying asset. On the other hand, options contracts give you the right, but not the obligation, to buy or sell an asset at a predetermined price before a certain date. While options can protect against price movements, they can also carry risks due to their time-sensitive nature. Now, how do you actually hedge options with futures? One common method is the short hedge. This means taking a short position in a futures contract to offset a long position in an option. For instance, if you own a call option on a stock and expect its price to rise, you might sell a futures contract on that same stock. This way, if the stock price falls, the gain from the futures contract can help cover the loss from the call option. Conversely, there's the long hedge. This involves buying a futures contract to hedge a short position in an option. This can protect you from potential losses if the price moves against you. Let's look at a practical example. Imagine you have a long call option on a stock and you anticipate that its price will increase. However, you want to protect yourself against the risk of the stock price dropping. You could sell a futures contract on that stock. If the stock price does fall, the profit from the futures contract can offset the loss from your call option. Position sizing is also essential when hedging options with futures. You need to manage your position sizes carefully to balance the risks. This involves calculating the delta of your options, which shows how much the option price changes when the underlying asset price changes. Adjust your futures position based on this delta to maintain a balanced risk profile. There are benefits to this strategy. Hedging options with futures can effectively reduce your exposure to adverse price movements. However, it requires careful planning to ensure that your hedge works as intended. Keep in mind that futures contracts come with margin requirements, which can add to the overall cost of your hedge. Incorporating futures into your options hedging strategy can be a powerful way to manage risk in stock trading. Understanding how futures and options interact is key to using this strategy effectively.